Hey everyone, welcome back to the channel. Today we're breaking down the biggest takeaways from Federal Reserve Chair Jerome Powell's recent semi-annual congressional hearing. Just a couple days ago, Powell tackled key topics like interest rates, inflation, and the future of digital currencies, offering crucial insights into the Fed's economic outlook. Whether you're a market enthusiast or just looking to understand how these policies impact your wallet, this video has you covered. So let's dive in. Let's start with one of the hottest topics, interest rates and the overall economic outlook. During his testimony, Powell was clear that the Fed isn't in a hurry to cut interest rates. His reasoning is grounded in the current strength of the US economy. Last year, we saw robust 2.5% growth in GDP, and unemployment has dropped to a historic low of 4%. These numbers indicate a resilient economy that's weathering challenges well. Powell also pointed out that inflation is currently hovering around 3%, which, although above the Fed's long standing target of 2%, is being viewed in the context of a healthy, expanding economy. With strong consumer spending and a vibrant labor market, the Fed's approach is one of patience. They want to ensure that inflation is fully tamed before making any drastic moves with the federal funds rate. It's interesting to note that the Fed's earlier aggressive rate cuts, particularly when there were concerns over a weakening labor market, have given way to a more cautious strategy. Cleveland Fed President Beth Hammack mentioned that with the economy's momentum heading into 2025, the current conditions provide the luxury of maintaining steady rates. This careful approach is designed to balance short term economic stability with long term growth goals, ensuring that any policy changes are data driven and measured rather than reactionary. Now, let's dive into one of the more heated debates from the hearing, the future of the Consumer Financial Protection Bureau, or SCFBP. Established in the aftermath of the 2008 financial crisis, the CFPB was designed to protect consumers from abusive financial practices. Over the years, it's been credited with returning over $21 billion to consumers and has played a vital role in overseeing an $18 trillion consumer lending market. Senator Elizabeth Warren, who was instrumental in the creation of the CFPB, used strong language during the hearing to defend the agency. She warned that dismantling the CFPB would essentially signal the end of robust consumer protection. Imagine every checking account, credit card, mortgage application, and car loan being stripped of oversight. She likened it to having a sign that says, "Cop have been fired, let the scams begin." On the other hand, Republican lawmakers argue that the CFPB hasn't been held sufficiently accountable. They contend that its broad authority may sometimes lead to overreach, especially when compared with other regulators who still perform audits and supervision. In response, Powell explained that the post 2008 reforms were designed to centralize consumer protection in a single agency, insulating it from the fluctuating pressures of political cycles. When asked about who monitors consumer compliance outside the CFPB, Powell admitted that there isn't any other federal regulator with a comparable mandate. This debate is not just about numbers, it's about philosophy. It pits the need for robust, centralized consumer safeguards against calls for increased oversight and accountability in a system that many believe should be more balanced. Regardless of where you stand on the issue, Powell's testimony underscores that while the system isn't perfect, the broader banking framework remains secure. Another key point that Powell addressed was the persistently high mortgage rates, a topic of great interest to homeowners and potential buyers alike. Despite the Fed's earlier rate cuts designed to stimulate the economy, mortgage rates have not followed suit. According to Powell, this disconnect is largely because mortgage rates are more influenced by long term bond yields, such as 10-year Treasury notes, than by the short term policy rates set by the Fed. What does this mean in practical terms? Essentially, even if the Fed holds rates steady or even cuts them, homeowners might not see a drop in mortgage rates immediately. The bond market, which is driven by longer term economic expectations and global demand for safe assets, plays a critical role here. Powell did leave a note of optimism. If the Fed maintains its low rate policy over a prolonged period, there could eventually be a downward pressure on mortgage rates too. However, he was quick to point out that the timing of such changes is hard to predict. For many consumers, this dynamic serves as a reminder of the complex interplay between federal policy and market forces. It also underscores why, despite favorable economic indicators, everyday borrowing costs remain somewhat detached from the Fed's headline rates. Finally, let's talk about digital currency. a topic that has sparked debates and speculation for several years. The possibility of a central bank digital currency has been on the table for many central banks around the world. However, during the hearing, Senator Bernie Moreno pressed Powell directly on this matter. Powell's response was unequivocal. As long as he's the Fed's chairman, there will be no development of a digital currency. This is a significant statement, especially when compared to countries like China, which is actively developing its own digital yuan. Powell's decision not to pursue a central bank digital currency is rooted in the Fed's current priorities, maintaining financial stability and relying on traditional monetary tools. The introduction of a digital currency would not only represent a major shift in how the monetary system operates, but it would also introduce a host of new challenges, including cybersecurity risks, privacy concerns, and potential disruptions to the established banking framework. By shutting down the possibility of a Fed backed digital currency, Powell is also sending a clear signal to the market. The focus remains firmly on proven economic strategies and gradual policy adjustments. This decision provides a reassurance to those wary of rapid, untested changes in our financial system. In summary, Jerome Powell's congressional hearing offered us a comprehensive look into the Fed's current stance on several pivotal issues. Here's what we learned today: interest rates and economic outlook. The Fed is taking a cautious approach given a strong economy and a solid labor market, despite inflation lingering slightly above target. CFPB and consumer protection. The debate over the CFPB underscores a broader struggle between ensuring consumer safety and demanding accountability from regulatory agencies. Mortgage rates and bond yields. Even with low Fed rates, mortgage rates continue to be driven by long term bond market dynamics, emphasizing the layered nature of economic policy. Digital currency. Powell's clear stance against developing a central bank digital currency signals a continued reliance on traditional monetary policies, ensuring stability in an evolving financial landscape. What do you think about these developments? Are you for maintaining the status quo in consumer protection, or do you believe reforms are needed? And how might these trade and economic policies impact your financial future? Let me know your thoughts in the comments below. If you enjoyed this detailed breakdown, please hit that like button and subscribe for more insights into economic policies and financial news. Thanks for watching, and I'll see you in the next video.